What if money expired after 1 year? Imagine a world where all money expired after 1 year, forcing people to spend it within a fixed time frame. This drastic change would fundamentally alter how we manage finances, save, and invest. People would be incentivized to spend or exchange their money frequently, affecting global economies. Impact on saving and investments. Savings would be significantly impacted, as money could no longer accumulate for long-term goals. Traditional savings accounts, retirement funds, and long-term investments would become obsolete, forcing people to rethink how they approach financial security. Wealth preservation might shift to tangible assets or other currencies with longer validity. Rapid economic cycles and consumer spending. With money expiring after a year, consumer spending would likely surge. People would be motivated to buy goods, services, and experiences quickly, boosting the economy in the short term. However, this could lead to issues of overconsumption, waste, and environmental concerns, as the urgency to use money might outpace thoughtful purchasing decisions. Changes to business models and pricing. Businesses would face constant pressure to sell their products and services within a limited timeframe. This could lead to frequent price adjustments, promotions, and discounts to encourage consumer spending before money loses its value. The financial landscape would shift toward a more dynamic, time-sensitive model of commerce. The rise of new financial systems. To adapt to this new system, alternative financial tools could emerge. People may begin using barter systems, digital currencies, or time-based exchange systems to store value without worrying about expiration dates. These alternatives could become more popular as people look for ways to manage their wealth outside of traditional cash. Impact on debt and loans. Debt would take on a new meaning if money expired. Borrowing could become more complicated, as lenders would want repayment before money loses its value. People could face pressure to repay loans faster, creating a higher risk of financial instability for those unable to keep up with repayment deadlines. Changes in government and policy. Governments would need to implement strict financial regulations to control the flow of expired money. Policies would be crafted to prevent inflation from skyrocketing as large amounts of unused currency flood the market. Central banks might have to intervene more frequently to ensure the system remains stable and functional. Behavioral shifts in personal finance. People's attitudes toward money would likely shift dramatically. The concept of living for today might become more prevalent, with individuals focusing less on long-term financial planning and more on immediate gratification. This could change cultural norms around savings, wealth building, and retirement planning. Environmental and social consequences. The push to spend money before it expires could lead to increased waste and environmental harm. On the other hand, some might argue that this system could reduce hoarding, encourage charitable donations, and help redistribute wealth. The social implications would depend on how governments balance the system and regulate wealth distribution. A world in constant flux. In a world where money expires after 1 year, the financial landscape would be in constant flux. The need for rapid spending would drive short-term economic growth but could also lead to instability. This system would challenge traditional financial wisdom and force humanity to rethink how we value and use money.